Ever wonder why some people making, totally average salaries end up incredibly wealthy, while others pulling in six figures are literally always stressed about money? Welcome to This Explainer. Today, we're diving into a complete, jargon-free blueprint to show you exactly how wealth is really built. Spoiler alert, it doesn't take a massive salary or winning the lottery. It's actually all about consistent saving, disciplined investing, and giving it time.
Here's our game plan for today. We're going to redefine true wealth, build up your financial defense, cover the investing basics, unlock the magic of compounding, look at some crucial money habits, and wrap it all up with a practical 30-day action plan. Let's get into it.
Starting right off with part 1, redefining true wealth. Because honestly, a huge majority of people get this completely wrong right out of the gate.
Think of your money kind of like a leaky bucket. Your income, that's just the water flowing in. But your true wealth is your net worth. It's the water that actually stays in the bucket after your liabilities, your expenses, drain it away. So someone making $300,000 a year could actually be completely broke if they spend it all. On the flip side, someone making $60,000 can become a millionaire just by consistently investing over time. It all comes down to your net worth, your assets minus your liabilities.
And that brings us to the ultimate wealth killer, lifestyle inflation. Picture this, you finally get that big promotion at work, but instead of investing the extra cash, you immediately finance a fancy new car or upgrade to a pricier apartment. You bump up your spending every single time your paycheck goes up. Actually, the truly wealthy do the exact opposite. They bump up their investments way faster than their lifestyle.
All right, moving to part 2, financial defense. You literally can't play offense and grow your money until your defense is locked down. Spend less than you earn, period.
To protect your cash flow, you absolutely need a system. A super effective one is the 50-30-20 budgeting rule. It gives every single dollar a job. 50% goes to your absolute needs, 30% to wants because, hey, you still got to live your life, and a solid 20% straight to saving and investing. Treat this as your baseline, and if you can push that 20% even higher over time, you'll reach your goals that much faster.
A huge piece of that defense is stashing away 3 to 6 months of essential living expenses. Look, emergencies happen to everyone, right? A medical bill pops up, a sudden layoff, maybe a major car repair. Having this emergency fund sitting in a regular, accessible savings account is basically your financial shock absorber. It keeps you from panic swiping a high-interest credit card when life inevitably throws you a curveball.
And speaking of credit cards, we really need to draw a hard line between bad consumer debt and good debt, because not all debt is evil. Bad debt, like paying 25% interest on a credit card for a designer jacket you can't actually afford right now, absolutely destroys wealth. Good debt, though, is an investment in your future. We're talking about things like education that boosts your earning potential, smart business investments, or a reasonable mortgage.
Okay, so our defense is fully set. Let's shift gears to part 3, investing basics, where we start making your money actually work for you.
So how do we actually grow it? Individual stocks mean owning a tiny slice of a single company, but trying to pick the next massive winner is super risky. That's exactly why long-term investors love index funds or ETFs. Take an S&P 500 index fund, for example. It bundles the 500 largest U.S. companies into one neat little package, giving you instant diversification and seriously lowering your risk. Then you've got bonds, which are basically lower-risk loans you give to governments or companies, and, of course, real estate. The whole secret here is just spreading out your risk.
Which leads perfectly into our second big rule of wealth. Time in the market always beats trying to time the market. Honestly, the absolute worst mistakes happen when folks get emotional, like panic selling everything when the market dips or buying in just because of some crazy internet hype. Successful investors, they just stick to a consistent written plan and let their money ride, instead of stressing themselves out trying to guess exactly when the market is going to move.
And letting it ride brings us to part 4, the power of compounding. This is where your money starts doing the heavy lifting. Imagine investing just $500 a month. Thanks to compounding, your money earns returns. And then, here's the crazy part, those returns start earning their own returns. It's a total snowball effect. If you look at an average historical return of about 10%, the first few years might feel a little slow. But look at year 20, and oh man, by year 30, your wealth literally explodes upward. It's so unbelievably powerful that Albert Einstein is actually credited with calling it the 8th wonder of the world. Time is for sure your greatest asset.
Now, you might be asking yourself, why even risk investing at all? Why not just play it safe in cash? Well, if inflation averages around 3% a year, any money you leave just sitting around is silently losing its purchasing power. It's literally shrinking. Consistent long-term investing is the #1 strategy people use to outpace inflation and protect the future value of their hard-earned money. Moving on to part 5, mistakes and habits. Because knowing what traps to avoid is just as crucial as making the right moves.
When you look at successful wealth builders, they share a few non-negotiable habits. First off, they run far away from get-rich-quick schemes. And no way are they blindly following some influencer's hot stock tip without doing their own independent research. Instead, they quietly focus on building up multiple income streams, whether that's their salary, dividends, a side hustle, or freelance work. And most importantly, they measure their progress in decades, not weeks.
And hey, we have amazing modern tools at our disposal. AI like ChatGPT is fantastic for helping you categorize expenses, draft up a starter budget, or break down complex financial ideas so you can learn faster. But, and this is a massive warning here, never ever use AI as a substitute for real, verified, professional financial advice. Always double-check your facts through reliable human sources.
We are in the home stretch now. Part 6, your action plan. Let's take all these concepts off the whiteboard and turn them into a practical plan you can actually start today.
Here is your actionable 30-day checklist to build your financial foundation right from zero. Step 1. Calculate your net worth today so you have a clear baseline. Step 2. Set up that 50-30-20 budget so you're definitely spending less than you earn. Step 3. Aggressively build that 3 to 6 month emergency fund. And Step 4. Once your defense is locked in, begin consistently putting money into diversified index funds. You hold the keys here, you just have to take that first step.
Now, I do have to quickly remind you that this explainer is strictly for educational purposes. All investing carries risk, markets can and will bounce up and down, and past performance is never a guarantee of future results. Always do your own research and consider chatting with a qualified professional before making any major financial decisions.
Ultimately, true wealth is rarely built overnight. It's built by making hundreds of solid, disciplined financial decisions over a long period of time. So as you look at your own financial future, I have to ask, are you going to settle for the temporary thrill of lifestyle inflation, or are you ready to commit to the consistent, patient habits that actually build long-term freedom?